I'm just waiting for YouTube to get loaded. I think we're just about ready. Once again, thank you all for your patience. Beautiful. Okay. We're ready to begin. So before we get started, for everybody who just jumped in, thank you for finding the correct link. It's always an adventure working with me in Zoom. I don't know why I mess the same thing up all the time, but I always do. I was in the right, I was in the right account this time, which is growth for me. But yes, we are. Oh, wait a second. It doesn't say that we're recording here, does it? Thank you. Thank you for making that point. Let me make sure that we are recording. Thank you, Juanita. Let's see. Because it should give me that little. There we go. Really appreciate that. Now we're 100% ready to go. So I think that with me and Zoom, like I was saying, here we go. It's always an adventure. Oh yeah, listen. I need 50 to 100 replays too. So definitely appreciate it. We are recording. We've got it going on YouTube. So we're gonna go ahead and get started. Here we go. Today, just like always, all right, we have to trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There is a possibility that you may sustain a loss equal to or greater than your entire investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. I'm actually going to pause the sharing of my screen and just jump to me talking for a second. For this class, that disclaimer is always important. For this class, that disclaimer is extra important because we are talking about short calls. And so when most of us are the writers of short calls, we do it in the form of a vertical, but there's still almost always, unless we're really slick with the way we structure it, and it's almost always going to put a risk down that is greater than the reward that you're working for. And so the first question to someone who's hearing this for the first time, and I know for me it was, why on earth would a trader do that? Why would a trader put themselves in a position where they can lose more than they stand to gain? And so I want you to think about short calls as something that has to be managed attentively and responsibly. And we're going to talk about how to do that today, but also to think about it in terms of you have to have a plan going into it of how much you're willing to lose, because the risk can be exponential. When you see how to structure a plan, and we're going to talk about a few different kinds, then it'll take, hopefully, the fear of it away. But I just want to encourage everyone who has not traded short options yet to practice them in sim a lot. If you have Thinkorswim, then you can obviously practice in sim anytime that you want to, because you just click on demand and practice it. So really practice, but we're going to go over the basics. All right. But I just want to make this very, very clear that it can be a great source of almost passive income. It puts the probabilities in your favor. We'll talk about all that, but you've got to be extremely careful when you trade these. All right. So with that, short calls, the purpose is to act as the seller and collect credit with the aim of price dropping away from your position. So the first two classes, we talked about buying options. We talked about buying calls when we think price is going to go up, or buying puts when we think price is going to go down. You can also actually sell calls. You can sell puts. So when you sell a call, you are collecting, before we were talking about the premium that you would pay for the opportunity for a contract to expand in your favor. When you sell, you're actually thinking about selling to collect that similar premium, but because you're selling, you're expecting the contract to diminish in value. And so when the contract diminishes in value, you sold something that was expensive, and then you can close it for a profit. That's the plan. And we're going to talk all through that. So in the market landscape, the seller is expecting a drop in volatility, causing a flat to bearish movement in the price of the underlying. The seller also benefits from time decay as long as price of the underlying remains below the short strike. So we're talking about trying to get when we're buying, I'd like to go back and forth for clarity. When we're buying, what we want to see is our calls go deeper and deeper in the money, inflating their value. When we're selling, we do not want to see that. When we're selling, we want to sell them out of the money and watch them go further out of the money, deflating in value. Now, time is always going to be on our side, as long as price doesn't spike against us. So just a quick visual of the type of trades that we would do depending on what our outlook on the market is. If we think that an underlying is going to go up, it makes sense to buy shares. It makes sense to buy calls. But today's class is on selling calls. You would sell calls if you think the underlying is going to chop around and go flat, never reaching up to your strike price. Or if you think that the underlying is going to drop. All right. Looks like I got a quick question. Tamika, I thank you for asking that. I'm going to stop sharing one more time. So Tamika's asking, am I referring to selling naked? I want to talk first about selling naked calls. And that's not because I promote the idea of selling naked calls. Nobody can do that. Well, nobody I know. I don't know. Maybe some people I know can do it. I assume most of us can't because it takes on limitless risk to the upside. If we talk first, right there with you, if we talk for a few minutes about simply selling one call and what happens to the price of that contract, whether price is moving against us towards that call or whether price is moving with us away from that call, then when we add the second strike, the long position to create the vertical, it makes so much more sense. And so that's why I want to teach it one leg at a time. So we are going to just focus on a short call to get the concepts really, really solid in our minds. And I think when we jump through these examples, it'll make sense. But I really appreciate that question because in my mind, I was actually going to address that from the beginning. So thanks a lot. So strategy for entry and exit of a short call. The market dynamics would be you sell to open. You're selling the call to open it. You would buy it to close eventually. You're selling out of the money when you believe the price will stay below your strike price. You believe price will move away from your short call, but insufficiently for a long call. Exit. Enough volatility and theta have decayed out of the contract. Remember that as volatility rises, that inflates the cost of a premium. So the more volatility implied in your contract, the more that contract is going to be worth. When we sell something, we want to sell it at high volatility, taking on that risk, but we're expecting a drop in volatility. We know no matter what, that theta is going to decay. Theta is when you buy an option, theta is working against you. When you sell an option, theta is working for you. No matter what, that's like it's one of the few things that we actually know is going to happen. Time is going to tick forward. With time ticking forward, that's always going to be working in your favor. So the same way that theta was working against you when you're buying, theta is working for you when you're selling. And you exit when price has moved efficiently away from your short call. Buy to close for your profit trigger or allow the short call to expire for the full credit. A good platform, I use Thinkorswim, will allow you to analyze a trade before it is sold or bought. We're also going to talk a little bit about option strat today. I'm sure there's a lot of you that are already familiar with option strat, but I'm going to show option strat because their risk profile is, I just like it. It's nice. It's a nice risk profile. So the short call or long put, what is expected? We want to know what the implied move is. We want to have a directional bias. When you're selling a short call, you want to have a bearish to neutral bias. And what that means is a bearish bias is you expect the underlying to drop and go lower. A neutral bias means you expect it to chop around and not necessarily drop, but it's not going to go higher significantly. And so you don't necessarily need price to move in your direction as long as price doesn't move against you. So you need to think about the market direction. You need to think about the sector that it's in, what direction it should be headed. You want to be thinking about the direction of your actual underlying. So this is all just concepts to get us thinking about market momentum from a broad picture down to the actual underlying that we're talking about. And you all know me, we'll be talking about SPY. So that's pretty much just market direction with me. How long do you want to be in the position? We'll be talking about multiple expirations and sort of the pros and cons to selling at different expirations. And you want to know, are you in any relevant positions? So for some traders who have been investing for quite a long time, they may be holding 100 shares of an underlying or more. That makes it possible to sell covered calls. When you're selling covered calls, essentially you're selling the premium of your call, but it's not affecting your margin because your margin is already tied up with those 100 calls. That's one way to look at it. Suzanne does a phenomenal job breaking down the ins and outs of the covered call strategy. And so that lecture is up on our website. What I'm going to talk about today as I get a little bit deeper is rather than thinking about it from a covered call scenario, I'm going to be focusing more in terms of a vertical. All right, so here is the promised example. And so what I have is obviously the 20 delta comparison across multiple expirations. And this is a screenshot that I took after market yesterday of SPY. So what we can see is from the option chain, 7 days until expiration, if you were to sell the 20 delta, you would receive a $1.38 credit. If you sell more time, 21 days out gives you almost double the credit, $2.58. So you're selling the same delta. And I want to take a pause here and stop sharing because if I talk with my hands, I can sometimes teach it better. We have talked up until now, we have primarily focused on delta in terms of how it relates to the price of the underlying and the inflation or deflation of your contract. So what that means is if I buy an option with an 80 delta, we know that that means that that option is going to fluctuate 80 cents for every dollar that my underlying moves. The other thing that delta is designed to tell us is the probability that the option chain, so traders all around the world are building this option chain fundamentally with their trades, with their positions. As their trades make the option chain fluctuate, it gives us an implied probability for what option should expire in the money, what option should expire out of the money. So today's lecture is focused on the 20 delta. The 20 delta is not going to fluctuate rapidly with the price of the underlying. It's only going to move 20 cents per dollar that the underlying moves. But it also has an implied probability to expire out of the money. It's implied to expire out of the money 80% of the time, because 20% of the time it's implied to expire in the money. That's what the 20 means. And so I want to actually take a moment and go back to the last time I stopped the presentation and I just talked. And that is when we were talking about the trading responsibly. If I sell a 20 delta, I know that I have an implied probability that 80% of the time that trade is going to work in my favor and it's going to expire out of the money the way that I want it to. That is not a guarantee. That's just an implied probability based on the way options are trading at the time I enter my trade. It can, something crazy can happen the instant I sell the option. And so I want to hammer this home now because I just want to be responsible in the way that I teach. I don't want people to leave this and say like, oh, no matter what, I have great, no, we want to combine some TA and we want to combine some great money management skills to make sure that if price is going against us, that we find a way to manage that position before it turns into something exponential. And there are ways to do that, and we're going to talk about those. The best way to think about it is to sell yourself enough time that you can manage. And by managing at first, I just mean rather than trying to be fancy and like flip legs around and all this type of stuff, manage just means, hey, if this thing goes against me by too much money, I'm just going to take the trade-off. But I'm going to talk about all of that as we go. Okay, so these are the comparisons across multiple expirations. And now I just want to show you what they actually look like in the option chain. So we're always essentially looking for the 20 delta. I went 19 to give a slightly better probabilities of success because 20 wasn't available on this expiration. You see that at the time that I was taking the screenshot, only 21 was available. So what this is saying is yesterday at about the close of the market, if I sold the 380 strike price, 7 days until expiration, I could receive $1.38 credit for selling that. With me receiving $1.38 credit for selling that, as long as price does not travel past this 380 at expiration, then I can keep this $1.38. So actually, the way that I should make this super clear, I'm going to bounce back to the chart. If price were to breach me, I have a chance to still be successful as long as I'm not exercised, which has been happening early for some folks. It's unlikely. You can be breached and oftentimes not exercised, but it is possible that when you're breached, you are exercised. But the big key is I want to see price stay underneath here or fall underneath here. Me personally, I'm almost always, if I'm breached, either rolling my option out in time, closing the position, finding another way to re-enter. Just my stomach doesn't like the idea of just being exercised, and like I don't like it. So when I sell and I'm breached, I tend to get out. But I just want to make the point that as long as you don't expire past 380, then you keep the $1.38 credit. Okay. Now you sell a little bit more time, 21 days out. Notice it's still the same 20 delta. It's still fluctuating at the same rate. But with you selling more time, you're taking on more risk. More can happen in the extra 2 weeks. And because of that, your contract is inflated. So it's you almost get twice as much credit for selling the 20 delta 21 days out from expiration as you do 7 days out from expiration. So as we go further out, now we're 30 days, even a higher premium, you're looking at $3.08. Oh no, on YouTube it's not. Regina, thank you for sharing that. I would really say that for this presentation, Regina, did that just start now, or has that been the entire presentation? Like, Is it from me bouncing back and forth? For anybody who can't see the chat, Regina just informed me that on YouTube, they can't see my screen, which makes it pretty hard to learn from this. Okay, got it. What I would ask everybody from YouTube to do now then, for this class, just jump into Telegram, click on the link from Telegram and watch this class on Zoom. And we'll make sure that when we upload this to YouTube for a couple of days, that we use the recording that came off of Zoom. All right, so I think that should make it work for everybody. So definitely apologies for that. Juanita, you're the real MVP because we got a good recording because of you speaking up. So definitely appreciate that. And Regina, thanks a lot for bringing that to our attention. But let's just try to make sure that everybody comes over from YouTube over here. All right. So let's see here. So again, I just want to point out that as we go further out in time, we are taking on more risk of fluctuation, but we're receiving more credit. And so now I have a couple slides to kind of demonstrate this idea. And so this is the same SPY chart. It's taken at the same time. I took it last night, but we're not looking at daily candles anymore. I'm going to try to quickly bounce back. We're not looking at daily candles anymore. Oh no, I'm sorry. Both times I gave us weekly. Apologies. We've been looking at weekly the whole time, people. But the point for me making this weekly picture is 7 days to expiration is enough time for a weekly bar to print. And so notice this box that I drew on from just a few weeks back, how far price is reaching. And so now if I move that same, all I did was picked up the box, moved it to where price closed yesterday. And you'll notice that in just 1 week's time, I want to talk about risk a lot in this presentation, just to be responsible, not to scare anybody, but so that we go in with clear eyes when we go into our demo accounts and we practice. In a week's time, you do have the opportunity to have 3 of these strikes taxed by price. And so another thing that I don't know if I made clear when we were looking at the option chain, notice that not only as you go further out in time, not only does your premium go higher, and so you receive more, but also because the premiums are inflated, because Vega and Theta are inflating your contracts across the option chain, you can actually sell further away from current price. So 7 days till expiration is pretty close to current price. 21 days, we get further, till all the way 44 days out, you get further as well. So it's a good way to think about it. If you're adding time, you are giving yourself a little bit more space away from current price, and you're giving yourself more ways to manage. The less time that you sell, the closer you have to actually sell to current price. But I think that a good thing for people to think about as they're considering strategies is to really think about how much an underlying has been fluctuating and decide what type of risk you want to take on when you're selling these contracts. Okay, so we're going to go forward talking more about the risk. This is what a generic profit and loss scenario for short calls looks like. It's a neutral to bearish strategy. If you enter while price is trading flat, you'll keep your entire premium. And so you can see that entering, the idea is you're selling the 95 strike price, pardon me, you're selling the 100 strike price. Price should be trading at 95. If price closes above you, then all of a sudden you're responsible for 100 shares times however many dollars past your strike it went. So if we bounce back to SPY and we think, well, I sold this call for at 380 and I collected $1.38 for credit. Well, that means I'm actually protected from risk for $1.38 higher than that strike. So 381.38, if SPY is trading right there at expiration, well, it just sort of took away the premium that I sold it for, but you know, I don't actually incur a loss. If we go higher than that, then all of a sudden I'm on the hook. So if we go up to 382, then I'm on the hook for the difference. So I'm on the hook for 62 cents there. Which is $62, I want to make clear. If we go up another dollar from there, it's another $100 for every dollar. And so very quickly, you can see if I sold this and I sold it for $1.38, it's only going to take $3 higher than that strike price for me to really blow completely through and lose more than what I was paid. And then if price continues to go higher, like imagine you don't get out, you decide that, well, I'm just going to hold it at 390 and let it fall back down and I'll be okay. Well, now you've lost, you know, close to $1,000. So these are the thought processes that we have to go through when we're considering these risks. So a little bit about the Greeks. The benefits of a neutral market, which while we are chopping, like you notice 1, 2, 3, 4 bodies of candles for the past 4 weeks haven't really gone far. Like they've opened and closed around the same place, but look at the range that we've been in. So we have been chopping, but I wouldn't say that volatility is really going anywhere right now. Just want to make that clear. Benefits of neutral markets is volatility drops, theta decays. Benefits of bearish markets is delta and gamma decrease in correlation to price. So that means, I'm just going to bounce back to the chart real quick. If you have just a great idea, say selling as price is trading here, maybe you had ideas to sell way up here. Well, a week like this, delta is going to move so far away from you, from where you sold so fast, that you're going to be able to get out in profit really quickly. What you don't want to do is have that same idea somewhere around here and all of a sudden delta is screaming at you. So we want to understand that that 20% chance is a probability, and we want to blend that probability with really solid TA and planning. Risks for neutral to bullish markets is price is moving towards that strike and Vega doesn't decrease efficiently. All right. So here is our bearish scenario selling a short call. And you all know that by now how I like this diagram because it adds the theta component. And you can see that this time theta is actually helping us out. So time is on our side. What's not on our side is a rise in price. Price can theoretically rise forever. And so that's why the exponential loss is there. It's because theoretically you could have like a GameStop scenario where you're selling calls and price just keeps rocketing against you. So that's what that means. All right. And so what we're looking at here also, we have these little profit bubbles, which is nice. Notice that it's a stagnant profit bubble. There is a limited upside. The most that you can gain from selling a call is the premium that you sold it for. Once you hit that premium and the price goes down to zero, you can't make any more money from it. All right. But obviously that's not the case when it goes against you. So the big thing to keep in mind is the reason why would somebody sell options? You sell options to put the probabilities on your side. But you also do so responsibly. And you're always thinking about an exit strategy in case this is one of the 2 out of 10 scenarios where price goes against you. If we want to accept the probabilities, then we have to know that if we put on 10 trades, we should expect and anticipate that 2 of them are going to be losers and are going to take money away from our profits. And that's okay. It doesn't mean that we're bad traders. It just means that that's what it means to be a trader. So here is an idea that I had. And once again, I'm gonna pop off the share. This plan that I'm gonna share, I think is really malleable, and it's really simple to explain. I'm really excited about it. It's not one that I just want people to say like, oh, that's my trading plan. I want people to kind of understand how I came up with this idea, and then understand also how to tweak it and play with it to make it work for themselves. All right. So this is just sort of a rough outline of how to trade or how to think about selling calls over a 10 trade basis. So if we say, okay, I'm going to set out to sell the 20 delta call, and I'm going to do it when my chart does X, Y, and Z. When it gives me the signal that price should be done climbing or price is ready to drop, then I'm going to sell at the 20 delta. And I want to be as sharp with my TA as I can to give me the best probabilities to have price not work against me. But I'm going to plan on that option chain's probabilities being true. Meaning I'm going to plan on 8 are going to work for me, 2 are going to work against me. And I have to make sure that I keep those 2 that work against me in check so that they don't take away the profits from the 8. So that's what we're going to try to talk about today. So a 20 delta is statistically implied to expire in the money, which is not what we want if we're selling 20% of the time. This will incur a loss for the seller of the option that will likely be significantly greater than the premium received for sale. A 20 delta has an 80% probability of expiring out of the money, which is what we want, allowing the seller to keep the premium received without incurring a loss. Selling premium can be a powerful strategy, but it must be done responsibly. So here's just an idea that I'm going to talk through. All right, so a 20 delta, and this is from my example. The idea being that we're going to talk about that 21 days till expiration on SPY that was trading at $2.58 credit. And so that was just one of the expirations that we looked at. All right, but the key is that it's 20 cents. That's 21 days to expiration. And generically, not every time, but generically, we can think to get a similar premium. Obviously, that's going to change if volatility drops out of the market. Then that $2.58 credit for 21 days to expiration is going to be lower on the 20 delta. If volatility spikes even higher, then that $2.58 credit is going to be higher than what it is right now. Okay. Over the course of 10 trades, we assume 8 winners and we assume 2 losers. We're going to, and this is the part that I want you to think, you may do this differently than me. Exit the trade for a loss when the position reaches 2 times the credit received for the loss. And so for anybody who doesn't understand that piece, I sell it for $2.58. If price stays flat, then over 20, like just imagine this crazy scenario where price stays completely flat. It's not going to happen, but price stays completely flat, then whatever the theta is on that call, I know that I'm going to make that theta in profit every day. Every 24 hours, I'm going to make that theta in profit. It's going to keep on adding to my position. If price falls away like I wanted it to and expected it to, then all of a sudden delta and then gamma is going to start to kick in for me too and really shrink the cost of my contract and help me to get out faster. If price spikes and goes higher, then all of a sudden the cost of that contract is going to go up. When I sold it for $2.58, now it's worth more. It's worth $3. It's worth $3.58. It's worth $4. When we're selling, we should expect a little bit of fluctuation. Well, when we're trading in general, we should expect fluctuation after we enter. So just because price moves against us by a little bit, we don't want to just close the trade. We want to remember why we got in the trade at the first place. And so my idea, and this would be different for everyone, is to think about it in terms of a 2x loss. If I sell a call, it's because I think price is going flat or down. If I'm looking at a 2x loss, that means that I was wrong, more than likely. More than likely, I was wrong. More than likely, it's not just like price went up and then it's going to come back down. Maybe I wouldn't recommend playing around with it. I would recommend with being humble and saying like, hey, you know what, this time, for whatever reason, blame it on TA, blame it on the news, blame it, like whatever. For whatever reason, I was wrong. So at 2x loss, I'm going to take the trade-off. All right. We're going to explore what would happen in the hypothetical situation that you have 8 winners and 2 losers, and those 2 losers are a 2x loss. Okay. So 8 times $2.58 gives us a total credit received of $20.64. $2.58 times 2 equals $5.16. That's the planned max loss. You have to be really, really wrong for that. And the other reason that I would say the argument I make for giving yourself a little bit of fluctuation here is because if you have one bad day where price is going against you, and then it just falls away, it allows for that. This is a strategy that I would recommend that you do with it the sharpest TA that you can, but you understand that it's designed to be a little bit of a forgiving strategy. If price goes against you by a little bit, and you still have time to get out, then you can make a nuanced decision to get out. And I'm constantly trying to stress that if this sounds new and if this sounds foreign, to please practice in sim and talk about it in the forums and talk about how you look at it. But don't just say, oh, tomorrow I'm going to sell the 20 delta because I want to get 8 of these. I want to get 10 of these on as fast as possible. So don't think about it that way. Have a plan that's tight, that's thought out. Okay. But the $5.16, that's the planned max loss. We're going to expect that to happen. Take that times 2, and obviously it's $10.32. And so essentially, with this type of a plan over the course of 10 trades, you do experience a profit of $10.32. This is only one of many ways to look at it. You could look at it and say, I'm going to wait until 3x. You could also look at it and say, you know what? I want to limit the opportunity for price to move against me. So I'm not going to accept the full $2.58 premium. I'm actually going to get out when my contract is trading at 50% of its value. So there's lots of different ways to look at this. I just wanted to sort of share this broad outline to get the conversation started. And I'm going to pause for questions. And then we're going to try to look at an option chain and talk about how to convert this idea, or how I like to think about converting this idea into a vertical, because a vertical does not have exponential loss. But I will say that when I trade verticals, I actually think about them more like this than I do just straight like verticals. In other words, when I trade verticals, and this is a little teaser for the second half of the conversation, I almost always, unless I'm being fancy, which we're not going to talk about the fancy style, unless I'm being fancy, when I trade verticals, I like to sell the 20 delta and then buy the cheapest call possible to cover my exponential loss. But really the way I think about it is I'm just covering my margin, because I'm always going to get out long before an exponential loss is incurred. All right, so I'm going to stop here, allow for some questions, and then we'll talk about some verticals. And just so everybody knows, questions, please come off mute, type them in the chat, what have you. I tend to wait with my questions for a while. It's just a habit that I learned as a teacher, is sometimes, and actually just for myself, I'm filibustering right now. So you can actually type your questions now or cut across me is fine. For me, sometimes I need a few moments to formulate my question when I'm thinking about new ideas. And so when you notice that I just sort of sit here for like 20 seconds and it's awkward, I am just trying to let people do that. I also want to encourage new traders to please ask questions. And so I can remember, actually it's like a year ago this October when I really started to learn a lot about options. And so those of y'all who was trading with me a year ago and remember my Netflix fiasco at earnings and how Suzanne was there helping me, you remember that after that happened, there was a lot more questions coming from me. And we'll tell that story maybe at the end, because it's a really, actually, to me, it's a beautiful story about Suzanne. But let me pause for a minute, see if there's any questions. So I'm going to stop talking.
I have a question, Jay.
Yes.
Is there any way you can, I think since you're focusing on SPY, can you show like the spread, exactly the short call, where you believe, I don't know if you haven't gotten to it yet, but so, okay, I believe this was going to happen. So I sold here. This is the short leg. And then the long leg would be above it. I don't know if you just maybe haven't gotten that to. Sometimes I just like to I like to visualize, and I need to see it on the chart if that's possible.
Okay. Absolutely. I'm going to, when I do that example, it's not necessarily going to be, I don't think that we have time for actually not even that we don't have time. I'm having a hard time justifying selling in this environment, even though there's people who do it great. So I'm not going to say like, oh, I saw this and it made me want to sell. Like when I showed that, like that range that we're looking at on the weeks, it's just not good for my mentality doesn't want to sell right now. That doesn't mean that other people won't. So I want to make it clear when I show how to construct these, it's more about like, this is how I'll cap my risk. I shouldn't say that. I'm sorry. I want to be very accurate. I have been I have been selling. I'm not comfortable telling people you should sell here. Because oftentimes I'm finding in my trades that I'm not staying in them as long as I wanted to. Like I'm having to manage them faster than I want to. So sometimes it's like, okay, I don't want to stay in this as long as I planned on, or I have to take a small loss here, or I have to take a small profit here. It's that. So I just want to be very careful when we get into it that I'm not making trade recommendations, because this is really it's just a choppy environment. So the question is, isn't it better to sell now with premiums being high at the moment? Yes and no. Like that's what's tough about it. Yes, we can get some great volatility And so it's super helpful to do so. We have to be what I'm trying to say is we have to be very careful. It's not necessarily a great time to sell if you don't know why you're selling, or if you don't know why you maybe made a mistake when you sold. And so I just want to be really clear about those exponential losses that we can take if we sell at the wrong time. That's all. So it's not saying don't sell. It's saying please understand your trade management. And really where this is coming from with me is when I first learned how to sell, I didn't have a good model in my mind for how to manage my risk. And I feel very fortunate that I never blew up an account. Like I just never did that. But I didn't have a plan that said, oh, when price moves against me to this degree, I should get out. I didn't have that. I just had like, okay, I'm selling because it should work. And then, oh yeah, it's working. Okay, cool. Or I'm selling and it should work. Oh no, it's not working. Oh no, and I'd get out. And so my big point there is just have to make sure that you have a plan that is structured. Lynn, that is a super clear question. And I appreciate you asking that. So to anybody who can't see the chat, it's just about like, how do you implement these 10 trades? I think, yeah, so I'm hoping that the idea would be, oh, these still have my drawings from a video that I haven't released yet. So let's see, let me clear these drawings off. Oops, I always do that. Okay, so we don't want to just sell at random 10 trades. What I was thinking more of is we see something in the chart, like for example, if we notice that we have some resistance here and we wanted to sell against that, that would be a trade. Let me see if I can back up a little bit. We noticed that as price traded up here, which we talked about a couple weeks ago, and it trades into some resistance, we sell against that. We notice that price comes here, we sell against that. That's not a lot of trades. That's 1, 2, 3 trades. Can you be artful and find different ways to do it outside of that? Yes, of course. But I'm not saying like just throw on 10 trades at random. What I'm saying is, as just part of your trading plan, saying, hey, one of the ways that I can implement a bearish to neutral bias is if I sell calls, or if I sell covered calls or covered verticals, or call verticals. And you do that at a time when the charts tell you that it's a smart idea to do that. With that being said, you still keep in mind, if you're consistently selling the 20 delta, there's a chance that you could be incorrect. There's a chance that you thought like, oh, it would be a good time to sell. Like maybe here's an example. Hey, price kind of came up, seemed to fail in this gap. So I'm going to sell right here. 1, 2, 3, 4 days later, and price is really moving against me. Now, depending on how far away you sold, you might not be concerned by this. This could still be okay for you. If you sold while price was trading around here at 370 and you were selling at 390, this is probably not actually going to incur your 2x loss as long as you sold enough time. It really, I can't imagine a scenario where it is incurring your 2x loss. And so with that, hey, even though you were pretty wrong in your selling, price didn't rocket so far. Price actually consolidated for 3 days. So for these 3 days, theta was working for you. Then price backed off again. When price opened here, which is roughly where you sold in the first place, you were feeling great because you had all these days of theta. And then as price fell, you were like, ooh, I can get out. And so I would say, I hope that that answers your question. You want to sell based off of what you're seeing in the charts, but your trading plan, you know, the charts are a little bit, if you're just buying or selling stocks, or if you're buying or selling long calls, it's sometimes a little easier to make a trading plan that says, hey, if price goes against me by this many dollars, then my thesis was wrong and I should get out. But when you're selling, you also still have that element of time that is on your side. And so you need to have a plan that tells you to get out if price is threatening to really devastate your account or really take a chunk out of your account that you shouldn't be losing. You need to be ready to take it off. But you need to make that plan a little bit more nuanced because, you know, maybe price does actually violate a line in the sand that would get you out of a long put because it would just eat away at that contract too much. But if it violates that line in the sand and you've sold far enough away and enough time has deteriorated, then you might say to yourself, I didn't think it would go that high, but I haven't reached my planned loss. I'm going to be patient with this. And this is something that Suzanne preaches a lot, is stressing patience. You've got to be informed with your patience. It can't just be like, oh, well, price went there and I don't want to close it. So I'm not. So I hope that answers the question. It should be a TA informed decision. And it should also be a premium informed decision. I think that you need to be nuanced and have both going for you.
How do you calculate that max loss? Sometimes I like, rather than waiting for, you know, the window to pop up to tell me what the max loss, can you just quickly tell me how I can calculate it myself, just so I can have an idea?
Yeah. Yes. And I think that for the purposes of this, with where you're going with that should take us into the short vertical conversation, right? Because generally you're going to be doing this in the confines of a vertical. Is that correct?
That is correct.
Cool. Then we'll jump into verticals, because with a short call, there is no max loss. It can keep going against you. With a vertical, there is a max loss. And so as we jump into the option chain, I want to think about it in a nuanced way. I habitually, I put on trades with a max loss that I have no intention of taking and that I do not take. Does that mean that it's impossible for me to take the max loss? No, but it would be really weird situation for me to incur a max loss. Instead, I structure something that will give me a pretty wide max loss, but I know in my plan, I'm going to get out before that max loss is incurred. But so just know that we're going to come back to those concepts. Okay, let's talk SPY. We've got another day of data. This is my my sim account. And we have people, we have options expiration tomorrow. I'm not going short anything tomorrow. I just want that to be clear. I'm not. I'm not. Okay. So please understand that this example is just to sort of get the idea. All right. Let's just sort of start to look around at some places that could be quote unquote safe. Let's look for a 390 strike. Let's look to sell a 390 strike and find it and see if we can find a 20 delta that has any profit at the 390, because it's good and far away. That's all I'm doing. I'm not doing a lot of TA today. All right. And let's just start with over 21 days out. Let's see what the 390 is trading at. Hey, pretty close, right, people? 7, like that's pretty close. All right, so we'll go up a couple. We'll negotiate. We'll sell the 388. All right, because that's close to the 20 delta. All right, so we'll sell the 388. We'll collect $2.68. Now, let's put that line on our chart. Let's remember what tool to click. Come on, phone. Now. This is purple for some reason. I don't know why. I don't know why I did that. Okay. So we're selling the 388 21 days out. We do not have, the margin requirements to sell that naked. All right. So we're going to turn this 388 into a vertical, but our hypothetical, not real thesis is that price is going to fall. Price is not going to come up here. So I'm going to take it off the screen again. Hopefully this isn't annoying for people. When I sell a short position and I buy a protective call on top of it, that protective call is going to put a cap on my risk. However wide I buy that call for is going to be the max risk that I'm taking on it. All right. So, but when I do it, because I know I'm going to manage the trade before we get to a max loss position anyway, then I'm as cheap as I possibly can be. I am so cheap with that call. Like I'm buying it as far out of the money as makes sense to my portfolio. This is my style. Other people may be different. Okay. But I just want to explain it so that it makes sense. And the big thing is when you're selling a vertical, if it's out of the money to begin with, the short that you're selling is driving your profit and your loss. The thing that you're buying, the call that you're buying to cap the risk is not going to help you very much when price goes against you. So I don't want to overpay for it because it's not going to help me much anyway. That's my mindset. Other people are different. That's the way that I like to trade it. Okay. So I like to be nice and wide if possible. $388. Now, we're not going to look back in the option chain yet. Instead, we're going to draw a couple lines. We'll make this 355. Oops. You can tell that I'm sleepy. Why did I make that 55? It should be 95. Okay. Here we go. So 395. Let's say that I sell 388. I buy 395 for cover. No matter what I pay for these two premiums, or rather, no matter what I pay for this, no matter what I sold this for, I know that I put this position on for a credit because my short leg is closer to the money than my long leg. If it's closer to the money, it's worth more. If it's further from the money, it's worth less. The distance between these two legs, is $7. I have $7 risk on this position. My max loss is $700. If price goes way up here, it's a $7 loss because when we cross through this 388, then those calls are activated. That call is activated against me. 100 shares are moving against me. And for every penny that it moves, it's taking money out of my account for those 100 shares. However, when price goes to the 395, then my long strike at 395 is activated. When that long is activated, it puts a cover on my 388. And so I'm responsible for the space in between those two calls, the one that I sold and the one that's long, which makes money as price goes high. As price goes up and gets to that 395, it can go to the moon and back. It doesn't matter. My max loss is $700. Let's quickly look at those two strikes. So we said selling 388 and buying the 395. For this trade, I'm only receiving, I shouldn't say only, but I'm receiving $1.19 credit. Let's figure out why. I had to buy 395. I had to pay $1.50 for it when I bought it. When I sold the 388, I received $2.68. Now, generally, we're going to get a slight discrepancy when we plug these in because Thinkorswim is going to start to negotiate for us and try to get us in at the mid. So that's with it. What that means is when we try to sell the 388, it's going to try to sell us at the mid between these two strikes. When we buy the 395, it's going to try to buy at the mid between these two strikes. And that's the way it's going to try to get us into the trade. Generally, on a liquid underlying like SPY, you can get in at the mid. Okay, so let's go back here. $1.19 credit. Let's go back to the chart. Oops. $7 of risk. So no matter what, you keep the $1.19, let's call it $1.20 of credit, right? So it's the max loss is that $700 that move against you minus the $1.20 credit that you received. So your max loss is actually only $580 there. Your max profit is $1.20 because you don't have the ability to sell your 388 naked like you would have preferred. This is where style kind of comes into it. All right. So for me, think about that max loss and what I already said about the way I would manage a trade like this. The max loss on paper is higher than what I would have accepted anyway. I would have taken the trade off for a loss before we got to that price because I'm only going to go 2x the credit received. So why am I paying $1.50 for this? I don't want to. So with me not wanting to, this is just a way that I think about it. instead of this, sell the 388 and then find something cheaper. Because we're out in time, we're still going to pay more than I would like, but find something cheaper, get as close to 50 cents. And I'm making more money. I'm making almost $1 more by going way further out. Now 388 to 406 is more margin. Let's put that up on the chart. 406 is way up here. Because we might refer to this, I'm just going to make it a dotted line. Significantly more margin. So your risk is now, let's see, 406 minus 388. What is that? 10, 18. So it's $18 of risk. This is where I want to be careful about how I explain this. It's $18 of risk. It's $1,800 worth of risk, which is a high amount of risk. It is way more risk than I am willing to take on that trade. Way more. I don't look at it and so this is where the discipline of how to enter a trade and exit a trade is important. I don't look at that trade as $18 worth of risk because I know that I am going to exit the trade before we get anywhere close to that. Look at how SPY trades. Price would have to pass my original strike to put me in the realm of $18 worth of, like, it would have to actually pass this and then go past it. If I don't have the discipline to say, you know what, I thought price was going to go down. I thought price was going down, or I thought price was going sideways, but actually price just rocketed right through me. If I don't have the discipline to take that off, then I shouldn't be trading these things. I shouldn't be doing that. And so my point and why I make the case for selling a wide vertical is to collect a little bit more premium, to not overpay for a strike that isn't going to help you anyway. But you have to do it with discipline. It's, you know, if you don't have, and everybody knows themselves better than me, of course, if you don't have the discipline to say, hey, I'm going to take this off when I'm supposed to take it off, then you got to structure your verticals differently. But when I'm thinking about the type of trade that's a vertical for the sake of income generation, then this is the way that I'm going to do it. I'm going to pause here for questions.
I have a question.
Yes.
On your example with the, I think it was going to be 1,800, the 408, the 308 and the 488, selling the 388 and buying the, the 406,
Yes.
which had $18 minus the credit, which I believe was I think it was
214.
214. Then based just on that calculation, would your your stop loss, so to speak, then be 2 times the credit, or 428, and maybe that's probably what you would put it, like maybe have it just in there for?
Yes.
Would that be your stop loss?
Right. That I'll tell you how I would do it. And this is this is, you got to know yourself. And I'm talking to everybody, not just you, but everybody. You got to know yourself to know if this makes sense. I would put a alert on my contract if it got that high. So if my spread gets to that rate, then I'm going to put an alert on it so that I can know that I have to deal with it. But to be honest with y'all, even with that alert, I'm going to know because I watch the market too much. Like when I'm teaching my classes, I'm focused on the classes I'm teaching and I'm not thinking about the market. But then in between classes, I'm watching. So think about how high this would have to go before that alert goes off. I know that it's happening. And so I think another thing to think about with a scenario like this is maybe you don't necessarily get to that stop. This is something that happens. Maybe you don't get to that stop loss, but you get close to where you would be stopped out and the market's about to close. Well, now you have a decision to make. And because we have been gapping, like there has been a lot of volatility once the market is closed. And I'll just, to be really transparent, I have backed out of trades that were winners for me because I was not willing to accept I was like, man, we are actually in gap range right now. And that's not okay with me. So I would just take a small loss. Like I would rather do that. I'm a big live to fight another day. I'm not a mess around and find out. That's just my personality. But does that explanation make sense?
Yes, thank you.
Absolutely. I like the wait time because it gives me a chance to drink some water. It's nice. Regina,
Okay.
I saw you. Yeah, go ahead. What you got?
I know you get the with the 21 days, you get the larger credit, but there's so much time to wait for decay. What would you say you would take it off, or when do you take it off? It seems so long, if that makes sense. Waiting to get that credit.
But wait a second.
Or maybe am I incorrect?
Well, I would protest.
Okay.
That's how I would put it.
Okay.
What I would say is it's not okay. And actually, I'm glad that you said this because it gives me a chance to talk the option chain a little bit more. You have Theta's working hard for you at 16 cents when you're 22 days out. But let's also just look at this is what's kind of fun about SPY also is there's so many expirations. You go a week lower, and Theta's already working a little bit harder for you. And so Theta is like 1 week out, Theta's ramping up for you. But what you also have to remember is Delta is working for you. Your Delta is at 20 cents regardless. We're going to bounce back. Let's call this 20 cents because it's easier for my brain. All right. Let's go to the chart. Let's say.
Are you showing your screen? Are you showing your screen?
Oh no, this whole time?
The whole time. Haven't seen it.
Listen, y'all got to stop being so polite. Y'all didn't just tell me I'm not sure, but that's terrible. I'm sorry. Okay, so what I just did was took us through two option chains, and I'm going to do that again really quickly. All right, here's the 22 delta. I'm sorry, 22 days to expiration, selling the roughly 20 delta. You've got 16 theta. That negative number works for a seller. All right, that negative number is a positive for a seller. So it's saying that 24 hours later, you're going to have $16 in your account, which is like, I hear you. It's like, okay, $16, like that's fine. But you also have the delta working for you. All right. So if your thesis is correct, right? And let's just say we get a move. It doesn't have to be like a monster move. Let's just say it's roughly half of this candle, right? So, oops. Even if it's $3, that's $60 plus the 20 theta, almost 20 theta that you're getting. So that's $80. You sold your contract for $2.68. And so now, just by having a slightly bearish day, the next day, that contract just got 80 cents taken off of it, which continues to add up. So now it's $1.80. Let's say that price from here chops around for 2 days. And over the weekend, theta is still working for you over the weekend. So Saturday and Sunday, you're getting paid theta. Monday, when you wake up, that's now just going to be another 40 cents that's taken off of that contract. You're pretty close to halfway. And so some traders actually choose as sellers to just be super nimble. And so they'll sell when they get about 50% of their credit. They find a way to roll and sell some more. For me personally, and I'm talking specifically to people who are new, I would say we want to enter in a way that's saying like, all right, I'm entering as I'm trying to, sell against the peak of the chart. But what some traders choose to do is, and you can think about it like this as well. It's just sort of an interesting way to think, is you can say like, okay, I sold the 388. I got 50% off the contract just because I got a small little price move in my favor. And I got a little bit more theta decay. So guess what? I'm now just going to sell that 388 one more time. But I'm going to sell it now for 2 more weeks because I think that this move still has lower to go. It's either going to go sideways or it's going to go lower. And in my mind, I just want to keep on selling that same strike. That's another way that traders will think about it. Now, if you sell the strike as price has moved away from you, you can still capture some profit by selling a little bit further out in time. And so that's a way to do it. But I wouldn't look at this type of, in this environment where price is gapping so much, I wouldn't look at the strategy of income selling to say like, this is how I'm trying to make big, fast gains. I would say be a sniper with like when you're trying to really, hit doubles or hit triples or hit home runs. That's the time when you want to be thinking more in terms of using a diagonal, or you want to be using like, multiple debit spreads, something where the exponential risk is not so hard against you. When you're doing a strategy like this, where you're just trying to put the probabilities on your side, this is something to consider for a portion of your account. So a portion of your account is kind of chilling, selling premium for you, which shouldn't have to be managed all that intently if you're selling patiently. And then you have another portion of your account, of your trading account, that you're using to attack and try to really get delta and gamma working for you. So, you know, I definitely, I hear what you're saying. You're like, oh my gosh, you gotta be in this position. You don't have to be in the position forever. Also just understanding that, like, if you're selling, say you get in a nice rotation where every 10 days you're selling a 21 delta, but then you're kind of, you have a nice rhythm going where, you know, you're selling a 21 delta, you're able to get out, you're able to get back in, you're able to sell another 21 delta. It ends up being almost like a compounding investment strategy, as opposed to like you're trying to slam a home run. And so I just think that it's a good balance for a trading portfolio.
Okay, thank you.
For sure. All right, everybody, it's always a pleasure. I haven't heard any questions. I want, or any more questions, I should say. I want to make it clear. I always love to answer questions on Telegram, so always, like, never hesitate to reach out. But also just want to make sure that everybody feels comfortable. If this was very new for you, I want to encourage you to ask questions. If there's something that you want to push, I want to encourage you to ask questions, but please do that. It's always a pleasure. Thank you all very much. And if there's no more, then I'll say good night to everybody.
Thank you, Jay.
Thank you. All right, everybody. Good night.
Good night.